You're watching Stockwatch. I'm Simon Brown, and joining me to unpack your stock-related questions tonight, Nader, Benguela Global Fund Managers, Mark Du Toit, OysterCatcher Investments. Be sure to send your questions through via email, stockwatch@bdtv.co.za, SMS 41392, or on X at Business Day TV using hashtag Stockwatch. Gents, appreciate the time this evening. The rand, well, actually, the dollar is in free fall. The rand is hence going crazy. Couple of questions relating more than anything to should I be taking money off or should I wait? Grant, how do you manage the rand? Because the short answer is no one knows where it's going to be by the end of this show, never mind week, month, or year.
Yeah, absolutely, Simon. I think from my perspective with the rand is there's the short term and the long term. The long term inflation differential, interest rate differentials mean you can expect the rand to depreciate over time. In a sort of a long trajectory, I think it's depreciated at around 7% per annum since 2000, give or take. But you know, in some years it can be positive, in other years negative. But the trend is there. So what I would say is don't try and time it. If you have some money to take overseas, take it. And if you don't want to do it in one go, do it in a couple of tranches. But don't overthink it. You know, you might be wrong for a month or two or six, but eventually the long-term trend, it's the right move for your portfolio and for your asset allocation. That's what matters more than if you get it at 1820 or 1830.
That's a great point. I mean, Mark, your take on it, because I mean, to Grant's point, I mean, I think except for one level, I mean, almost every time I've taken rand, it's a little nervy, and then a little while later you look and you're doing fine in a year or so. Do you take a similar approach, or have you got a magic 8-ball?
Yeah, I mean, I guess our view is similar. I mean, I think that inflation differential, interest rate differential shows that our rand should depreciate over time versus the dollar. I think it's been pretty interesting the last few days is that the US dollar has been weak and the euro has been stronger. So we've actually, the rand's stronger versus the dollar than it is relatively versus the euro. But yeah, I think medium term, I think you're fine if you want to take a bit of money offshore now. We are running a trade surplus at the moment, so we're exporting more than we are importing as a country, South Africa, which means which is another reason why money is flowing into the rand and making it a bit stronger, and that can continue for a while. But yeah, I guess it depends on your longer term view and what you want to do with the diversification in your own portfolio.
Yeah, and the short answer is don't try and be clever, because the rand is cleverer than you. Let's go to some numbers. Mark, let's stay with you for a moment. FirstRand results, not a bad set of numbers all round. Cost to income sub 50%. I have to be honest, I didn't think we'd see the big banks get to that at all. Impairments improving. Your take on FirstRand, which is typically the darling bank in our market.
Yes, exactly that. I mean, another good result. Earnings up, like you said, 10%. Paying out, I think it's 59% in a dividend payout ratio now. So you're getting a great return. I think that, you know, FirstRand is pricing in a lot of uncertainty around the investigation into the commission agreements in motor finance in the UK. And that is really hanging on the FirstRand share price at the moment. I mean, nobody knows what the outcome is going to be and how big the redress will be. FirstRand's raised a provision of 3 billion rand, but I suspect it probably is not going to be enough to cover it. There's the first court case now in April, 1st to the 3rd of April. And then the financial board in the UK say that in May they're going to give more information about potential redress. So I think that is weighing on the share price in the shorter term, but the underlying business, particularly in South Africa, doing very well. And also saying that credit loss ratios have peaked and expecting them to come down further.
Yeah, absolutely. And we saw it with Nedbank as well, coming in with credit loss ratios much improved. Grant, your take on FirstRand?
I like it. I think this kind of overhang around this fine in the UK is giving you an opportunity to get in at a reasonable price relative to other banks. The quality is still there. It's still evident they are the best or one of the best in the market. And I mean, I think the fine, it might be worse than expected, but I'm a little more optimistic that, you know, there is a bit of balance required in the UK, that they don't want to break the sector. They don't want to break the ability for new car buyers to raise finance and put the brakes on that market too severely. So I think there'll be something of a compromise. These banks are well capitalized, like FirstRand. got plenty of cash, and you'll look back in a year or two or three, and this will have been a good opportunity to add to the portfolio.
Yeah, I take it, opportunity per chance. Mark, sorry, Grant, let's stay with you. Sanlam results also out today. I suppose they don't have so much of the climate side, which is what we saw in Santam, although those weren't bad numbers either. Sanlam, your take on those numbers and the long-term insurance market generally?
Yeah, we still like it. We're still constructive there. I think Sanlam has been a standout performer in terms of management. They've just operated incredibly well for a long time now. I've been around long enough to remember when Old Mutual went overseas. They went to London, they listed in the UK, and they went on that whole journey. And Sanlam just stayed here. They focused on what they do, and they do it well. And they've done an excellent job, even in their African expansion into North Africa. They've done that smart strategy there. And so I continue to believe this is one of the best management teams around. And I still think you can buy the stock here, and I still think you can own it. They have a lot of franchise value in the asset management, in the life insurance, in the brand, across the business. So I still like it. Still a quality business.
Mark, Sanlam for you?
Yeah, I think a good set of results. I mean, the insurers their numbers are quite messy at the moment. Sanlam's also got a lot of moving parts. But yeah, underlying business looks strong. And I think in the medium term, and they said that they are going to bed down the acquisitions that they've made now. I think that we will see perhaps some of the numbers slowing a little bit. But a very good business, great market share, writing good business. So longer term, I think you'll do fine to own Sanlam here.
Question coming through. Bidvest down almost 20% in 6 months. Is this an opportunity for us? Mark, would Bidvest be an opportunity at this price point?
Yeah, but Bidvest is starting to look interesting. We don't have an overweight position at Bidvest yet. We're starting to look at it more closely. Like the viewers said, the share price has come off quite a bit. They announced another acquisition today, which is quite interesting. A company called, I think it's pronounced Citron, has over 50,000 clients, runs out of 4 branches spanning Canada, the US, and the UK. So this is one of the first times that Bidvest is going across the water into North America. So it's interesting to see, what the trajectory will be there. But yeah, I mean, these businesses, they do well when they have good scale. The team that's doing the acquisitions within Bidvest has made some good decisions and nice additive acquisitions. So yeah, I think it is starting to look interesting. The share price also come off a lot, so good future returns, hopefully.
Grant, your take, Bidvest?
I think it does look interesting. They've come off. They had a big tailwind from the renewables. They were making a lot of money around that and freight a year ago, and the share probably ran a little bit ahead of that. It's pulled back. Earnings are soft at the moment, but I think that's in the base now. Looking forward, if we see an improving, this is a very big macro play as well. Yeah. If you want to play the industrial space in SA, you want to play the macro environment improving, you definitely can buy this one. I think it's a good business. Remembering also, this is the same DNA in terms of management as Bidcorp. Yeah. They know how to operate around different geographies, and I think their bolt-on acquisition strategy so far has been pretty clever and strategic. So I like it. I like the management team, and I think that you're buying them at a sort of earnings trough here if you get involved. So I think you can buy some. And
I like your point. It is that acquisition team. Bidcorp does the same. Small little bolt-ons, accretive, really working well. Grant, let's stay with you. Question coming through. Saw the Spur results, quite like it. Love myself a Spur stake. Is a Spur as a share worth a buy? Would you be buying Spur at current levels? Those numbers weren't bad. And truthfully, what is a tough environment for sit-down eating?
I have to be honest, Spur continues to surprise me year in and year out. I think that management team is remarkable. And, as a student, I worked at Spur. So I'm very close to that business at one stage. I think they continue to, I struggle to see how they're doing so well in this difficult economy, but yet they are. It's not one I would own. I don't understand how great the prospects are, but I don't think it's been a good investment so far. I think you're in a safe pair of hands there. So I won't comment on the valuation. I think it's but a solid management team at is well leave it.
Yeah, and it's doubled since the lows and pandemic lows. Mark, your take on Spur?
Yeah, I think that, our view is that the South African economy is going to improve. I know that there's a lot of noise at the moment. We're also seeing oil prices now below $70 a barrel, which is a tailwind for the South African economy, puts a bit more money into consumers' pockets, also expecting further rate cuts. So that's a nice tailwind for a company like Spur. Also, it's quite small in our world, so we don't look at it in that much detail, but I think given the tailwinds, it should do quite well.
In terms of small, another one that I imagine might be small in your world, Grindrod. HEP's down 26%. The market sold the stock off, quite aggressively, 5.5% today, somewhat off where it has been in recent times. Mark, would Grindrod be worth a look? There's the challenges in Mozambique in terms of the election violence. That seems to have faded away. Grindrod for you?
Yeah, I think that, certainly the numbers that they presented today were hit by the unrest in Mozambique, and then also they mentioned that the flooding in KwaZulu-Natal, which was earlier in their reporting, also held back their numbers. Also, they're busy with, they've got a discontinued operation. They exiting some private equity and some land that they had, so a little bit messy numbers. The medium term, they're very keen to participate in the private ownership of rail in South Africa. So they're setting themselves up to make a bid for concession from Transnet. And that really is the upside for Grindrod. It's difficult to put a value on that because you don't know what the deal is ultimately going to look like. Also, it's not a very expensive stock. It trades on a kind of an 8 to 10 PE, so forward-looking PE. So it's not expensive. Has an opportunity in front of it, but we can't value that opportunity. So we're sitting on the sidelines for now, but it doesn't look expensive. So
I take your point. Results were down. There is a lot of potential there. What are you seeing when you look at Grindrod?
I see a company with quite a bit of potential. So I think I'm quite constructive on the ability of the GNU to drive public-private sector partnership. And as Mark said, that opens a door for Grindrod to participate there. In addition to which, Transnet woes are not going anywhere anytime soon, and that Mozambican port operation they have and rail, they've set themselves up well to benefit from Transnet's woes. So I think they're well positioned. I think they can capture a few tailwinds, and they're probably 7.5, 8 times earnings, and fairly attractive. We don't own it because it's too small for us, but I think it's a decent little industrial, and you could look at it for sure.
Question coming through around the Sanlam and 91 merger. Question is, what's the view of the panel? That would be you two gents on the merger. Is there a clear winner between Sanlam and 91? Grant, let's stay with you.
I can see the sense of the deal, and I think it's a better deal for 91. Just my personal opinion. I think 91 has been struggling with distribution over the past year. That well-oiled machine of theirs is not delivering. They haven't grown AUM, net inflow-wise for 3 or 4 or 5 quarters even, from what I can see. So I think they needed something to shake up that pipeline. There's a natural outflow from SA, and they're going to harness that. So I think it's not a bad deal. It's a pity for SA, though, I must say. I don't like it from a jobs and an industry point of view. As an investor, I think it's decent for 91, and I can't say if it's going to move the needle for Sanlam or not. I don't really see what their benefit is, but maybe it's a cost saving. Other than cost saving, I don't know. So,
Mark, your take on the proposed deal? And is there a clear winner? Does it create an opportunity for 91?
Yeah, I think that it is a nice distribution angle for N91. I think that maybe it simplifies things a bit for Sanlam as well. I think benefits for both. Probably net maybe better, slightly better for N91. I would agree with that. I'm not sure it really would move the needle too much in the shorter term. For asset management businesses that do really well when markets are running and when they've got good flows start to follow after good performance. I think that's really what would drive N91 share price. N91 doesn't look expensive to us. We like it. We own it. Yeah, so we hope that the deal will benefit in 91.
Take your
Us
point.
too.
A question coming through, Mark, let's stay with you. Question's fairly simple. How do I manage my portfolio with potential tariffs that come one day and disappear the next? I have to be honest, I have no idea. Mark, I don't know if you've got a secret sauce in that regard.
Well, I mean, I guess tariffs are adding a lot of noise to the economy, the global economy at this point in time. We don't know where we're going to end. Tariffs ultimately have to be paid by someone. So I think that the tariff is going to be shared between the US consumer and whoever's being tariffed. It's not going to just be only borne by one party. But I think that, if in terms of your portfolio, you stick with the companies that you like, that you think have got good long-term prospects, and nothing that we've seen announced so far has been kind of a death knell for anybody. It's just a lot of noise. I think it's difficult more for a US company because, you have a supply chain that's been set up and refined over years, and potentially now you have to rejig that. So I think short term, it's actually going to be more painful for the US to be, oddly enough. And then if Trump's and the Republicans' plan works out, long-term benefits for the US. That's our view, but I mean, yeah, we stick with looking at companies and projecting the earnings and picking the ones we think will do better.
And ignoring the noise. I grant ignoring the noise. I mean, that's often what investing is, putting your head down and putting earphones on.
It certainly is. I think the advice for portfolio is to less is more. So do as little as possible. They might put a tariff up and you react to it, but he might pull the tariff down a month from now, and then you've sold out of a good stock or whatever the case may be. So focus on the quality of the company you own. And there's very little, we haven't seen tariffs, as Mark said, that are fundamentally changing a company's outlook. And if you are in one of those, then perhaps you should maybe risk manage a little bit or trim it, but generally speaking, tariffs are one-off as well. So the market reprices, and then it's done. Yeah. And unless there's going to be another tariff next year and the year after and the year after, it's in the price the moment it's announced within a day or two, and doesn't make sense to sell your stock there. Yeah. What you may think is there might be opportunities to buy good stocks on those short-term sell-offs, and that's probably what we should be thinking about as investors rather than selling.
Tariffs may be opportunity rather than fear. Grant, let's stay with you. Question coming through around clicks. Fair bit of sell-off in clicks since late last year. We've seen this in a lot of the SA Inc. Is this creating opportunity?
Definitely. I think you do. You want to be buying clicks here. They probably got a bit ahead of themselves, but it's an incredibly well-run business. It's very well positioned in South Africa to be defensive, but also capture growth as well, because they've got the front shop and the core business as well. If you see an improving South African economy, clicks will benefit from that. We've seen that already, and I think you'll see more of it. If the economy still is tough and grinds along, they've got their core sort of staples in the business that will support the defensive nature of the earnings, cost control, store rollout, pharmacy licenses coming through this year. I think it's just one of those you want to have in the portfolio as a long-term buy and hold. So see it as an opportunity.
Mark, clicks?
Well, clicks for us has always just looked a little bit more expensive. I agree that, I mean, it's a great business. It's kind of like a very stable, steady eddy. I guess that for us, it just looks like the valuation's always been a bit high, and we prefer to look at other companies that maybe have, not paying for so much growth into the future.
Question coming through around Discovery. We had results. The stock has been in an absolute tear. What, a year ago it was 110, now it's through 200. Mark, the question is, I've been holding Discovery. I'm now well in the profit. Do I continue to hold at these levels, or has it become unrealistically expensive?
No, I don't think it's unrealistically expensive. I mean, it has gone up a lot, but fortunes have also changed a bit for Discovery. So if we think back a year ago, there was a lot of worry about the NHI that kind of has been pushed out a bit or rolled back a bit. So less concern for that part of Discovery's business. Plus, there was a worry about the cash generated from the life business within Discovery, and those fears have been allayed a bit. They've got a lot of new businesses that they've been investing in over the last few years that are starting to mature now and generate more earnings. So they've got the Vitality business, the Ping An business in JV in China. They've got the Discovery Bank, which is going to go from loss-making to income generating this year. So I think that they have a lot of good things going for Discovery, and I wouldn't be rushing to sell it. I think that they give long-term guidance of about a 15% growth, and it looks like that they can hit that for a couple of years. So I think this is perhaps maybe a pullback, but not a good time to sell.
Grant, and the bank in particular, there was a lot of skeptics when they announced the bank, and here we are a year and a half early hitting targets. Your take on Discovery?
I think the execution has been amazing, and as Mark said, they're moving from investment phase to growth phase. So they're starting to monetize all this investment they've been making in various new business ventures. Cash flow is going to be improving, earnings are going to be improving, and I think it's a good one. I mean, if it pulls back much from here, I would certainly encourage, you need to buy it. So if you have it in your portfolio, unless you're a shortish term trader, you should probably just hold it, just put them in the bottom drawer for another couple of years. I think they're hitting their stride in terms of accelerating earnings and cash flow growth.
We've got to go to stock picks, but quickly before I do, question coming through. Richemont, is Richemont still one of the better luxury companies globally? Grant, let's throw it to you. Richemont?
Yeah, I think they are probably the best jewelry franchise. It's really good. They're hard luxury, as they call it. They're not the most well-rounded. If you're obviously looking for that, you want to look at a LVMH, etc., with other portfolios. So they're very good, but they're in probably the top 3 or 4, I would say, depending on which part you want to be in. Good business, long term. I don't think it's particularly cheap here. I probably wouldn't be a buyer at these levels, but if you have it already, the problem with a good business, if you sell it, you often don't buy it back. So try and hold on to it.
and Richemont does give you opportunity. Chantal Marx has taught me that more than once. Let's go to stock picks. Mark, let's start with you. The Foschini Group.
Yes, TFG. So the share price is down about 23% so far this year. So it's come off quite a bit. It was pricing in quite a lot of excitement for the two-pot discretionary income. It was going to hit the stores last year. December update was a little bit disappointing, and we saw the South African retail stocks pull back a bit. And then we also had the proposed 2% VAT increase, which put another negative outlook or a bit of a dampener on share prices. So that's why you're getting an opportunity to buy this business. We do think that the South African consumer has got a bit of a tailwind coming, lower oil prices, lower fuel prices, rate cuts still in the pipeline. So we think that there'll be more discretionary spending. And for the first time for a long time, South African real wage growth is positive, wages going up more than inflation, another tailwind for South African retailers. And we think that the South African business will grow and offset some of the weakness that we're seeing in Australia and the UK. But those businesses are also good, and in time will also deliver.
Yeah, no, it makes me happy. I'm a Foschini shareholder. Grant, you're going with Nike. I'm also a Nike shareholder, so double happy. What's your Nike case?
Yeah, look, and Nike's been selling off for a while now, but it's come off on they made some missteps post-COVID in terms of their strategic positioning, leaving some of the wholesalers behind and actually just pushing online too aggressively, and they've lost some of their leadership in the shoe fashion, etc. But I think they've got new leadership, new management. They've still a very strong brand. There's very good business underlying that. They've been through these cycles before. If you look at their history, 2 or 3 times, they've had to reset and revive the business. And I think they're sitting in exactly one of those positions again. I think they'll turn the business around, and it's a good opportunity to nibble on some of those.
Yeah, no, that was my thinking. I agree with both of you, gents. Excellent stock picks. That's all for tonight's Stock Watch. Thanks to our guests, Grant Nader from Benguela Global Fund Managers, going with Nike. Mark Du Toit, OysterCatcher Investments, going with Foschini Group. Up next, The Close. Stay watching.